Hi guys, it's Stock Curry, and the Fed meeting minutes came out on Wednesday. We've got to talk about what was in them, or more importantly, what was not in them. And then we've got to talk about consumer sentiment, which is now lower than the Great Depression. We're going to set the record straight on that. So let's get into it! Now, before we get into the Fed meeting minutes, I want to let you know that the crypto brokerage Voyager Digital has officially filed for Chapter 11 bankruptcy protection. The last time a major crypto exchange filed for bankruptcy protection, it was Mt. And that has been going on for 8 years now. And people who had money in the Mt. exchange still have not received any sort of compensation for their losses. So, unfortunately, this Voyager Digital, if you had money in there, it's very sad to say this, but it could be a decade or more before you get any of your money out of these bankruptcy proceedings. Now, at this point, of course, the Voyager Digital stock has been halted for trading. It's basically worthless. And I hate to say it, but Voyager Digital may be the first major exchange to declare bankruptcy during this current recession. They're not going to be the last. There will be more to come. And that's why we see cryptocurrencies themselves continue to struggle as people continue to pull money out of the cryptocurrency market, fear of losing all of their money. Now, I understand there was a major purchase of Shiba Inu, but it looks like that was probably an exchange or somebody that made that purchase. Some people are speculating it may have been Binance. Whatever the story behind that was, I don't think it was a bet on cryptocurrencies going up. I think it was a purchase needed for funding to help support people who are buying that particular cryptocurrency on some exchange out there somewhere. So those are my thoughts on that. Let's get into the next news. And we have fresh lockdowns ordered in China as new COVID clusters start to spread. Now, this, of course, is going to be more bad news for any company that does business in China, and that's why we saw stocks like NIO and Li Auto and Tesla and others go down today. If these lockdowns do spread, and especially if Shanghai locks down again, that's going to be especially bad for pretty much any Chinese stock or any U.S. company that does a lot of business in China. Now on to the Fed meeting minutes that came out on Wednesday, and I've got to tell you, they really didn't say a lot. The biggest takeaway was probably just the fact that the Fed is expecting to do a 50 or 75 basis point rate hike in July. So at least the 100 basis point rate hike is off the table, and it's only going to be a 50 or 75 basis point rate hike. We did see the market go up mildly because of that on Wednesday, but it really didn't go up a lot because really there wasn't a whole lot said in the Fed meeting minutes. The only thing the Fed meeting minutes really said was that inflation fears are increasing and the Fed would have to do a more restrictive stance in order to get inflation down. Essentially, that means larger rate hikes. The meeting minutes did cause the Treasury yields to go up as it becomes clear that the Fed is probably going to do a 75 basis point rate hike in July, especially if the CPI numbers come out at 8.8% like they're expected to. And the CME futures are pricing in a 94% chance of a 75 basis point rate hike in July. Now, the biggest thing that people took away from the Fed meeting minutes is the fact that they did not mention the R word, that is, recession. There was no mention of a recession at all in the Fed meeting minutes. Now, this is obviously peculiar, especially when the Atlanta Fed themselves is claiming that we are already in a recession. Of course, we'll get the official numbers on that on July 28th. Now, it's going to be very interesting to see what the Fed does at their next meeting here in July, because the Fed is going to meet before the official GDP numbers come out on July 28th, meaning the Fed is going to meet before we are, quote-unquote, officially in a recession, even though the Atlanta Fed is already predicting that we are in a recession. Now, what makes this recession so unique is the fact that hiring remains extremely strong and the unemployment rate remains extremely low. In fact, job openings actually went up in May. Normally, when you're in a recession, you see job openings drop and you see unemployment rates spike. That's usually one of the telltale signs that you're in a recession. And the fact is, we're just not seeing that. Unemployment remains historically low and job openings remain historically high. Now, what is interesting about this is the fact that the recession that we're currently in, and make no mistake about it, we are in a recession, it's not really showing up that much in a lot of the numbers. And the reason for that is because of the way a recession is calculated. Remember, a recession is calculated as the growth in GDP minus inflation. And the only reason that we're in a recession right now, it's not because GDP is significantly low. It's because inflation is significantly high. And when you do the math and you subtract out this very high inflation rate, it doesn't matter if GDP is at plus 6%. If you're subtracting out an 8% inflation, you still have real GDP at negative 2%. And that's why we are officially in a recession, even though in the economy, economically, especially in the job numbers, it's just not showing up. So the thing is, we are in what's called a paper recession right now, meaning we're in a recession on paper. We are technically in a recession, but it's not really showing up in the numbers, especially the job numbers. And that's why the Fed probably did not mention the recession word, is because even if we are technically in a recession, it's not really showing up in the numbers. The Fed knows they can continue to raise interest rates at a very aggressive pace, and unemployment is still extremely low. The job market is still extremely strong. And so the Fed has no worries about raising interest rates and sending us into a real recession. We could be in a recession on paper, who cares? The Fed is concerned about a real recession, one that really affects the economy and kills the unemployment, kills the job market. That's what the Fed is concerned about. The only reason we're in a recession is because of high inflation. So if the Fed can get inflation down without significantly lowering GDP, the Fed could actually, by raising interest rates, pull us out of the recession. It sounds kind of crazy. Normally, raising interest rates would put us into a recession, but if the Fed could raise interest rates enough to lower inflation, they could actually pull us out of this paper recession that we're currently in. Now, all of that said, while on paper, it doesn't really look like we're in a recession, consumers have a completely different viewpoint on the economy. Consumers say 2022 is the worst economy ever. That's right. Consumers say 2022 is worse than the Great Depression. I mean, really, worse than when lines of cars waited for hours for fuel in a deep recession in 1974, if fuel was even available? Worse than when unemployment was double the rate that it's currently at and inflation was twice as high as well back in 1980 and interest rates were at 14.5%? Worse than after the 9/11 attacks or when the entire global banking system was on the brink of failure in 2008? Come on! Consumers have gone crazy to think this is the worst economic time in the history of the United States. I mean, give me a break. But besides the fact that consumers are completely off of reality, there has to be some reason why consumers feel this way, right? And obviously there are very real reasons why consumers feel this way. First of all, we have an inflation rate that's the highest it's been in over 40 years. And the fact is, most consumers during their adult lifetimes have never experienced inflation this high before. So it makes sense that most American adults, when they're experiencing inflation, the highest they've ever had it in their entire life, or at least their entire adult life, that they might feel like this is the worst economy they've ever lived through. And quite frankly, they're probably right. Gas prices, sure, we don't have the gas shortages like we had during the 1970s, but gas prices are still significantly higher than they were during the 1970s. In fact, gas prices are the highest they've ever been. So obviously that could cause consumers to feel like This economy is the worst it's ever been. At least it probably is in their adult life. And while interest rates have not gone up that much yet, they are rising. And it is causing things to become unaffordable. In fact, when you look at the price of a house compared to the interest rate, and then you come up with a monthly payment on that, and you take that average monthly mortgage payment and you compare it to the average income of the average American, the housing market is now the most unaffordable in history. And yes, we did have much higher interest rates during the 1980s. I mean, interest rates hit 20%. But house prices during that time were significantly lower. The average house back at that time was $13,000. Today, it's $460,000. So when we look at home affordability, what we're talking about is the monthly mortgage payment overall. And the monthly mortgage payment overall, compared to the average income, is the highest it's ever been on record. So, sure, I can see why consumers would think this is the worst economy ever, especially when homes are the most unaffordable ever in the history of the United States. Kind of makes sense. So if consumers are currently experiencing the worst economy in their lifetime, why do consumers continue to spend at record levels? Well, despite these terrible consumer sentiment, the good news is that consumers are not yet slashing spending. The bad news is that might be on the way. You see, the reason that consumers have not yet cut back on spending is because their savings rates reached record highs during the pandemic. And so even as inflation rose and consumers had to spend more and more money on the things that they would normally buy, they had the money available in their savings accounts in order to afford all of these goods and services. However, as you can see on this chart, the Fed now shows that consumer savings accounts are the lowest level they've been since 2005. In fact, they're almost the lowest level on record. So consumer savings have been almost completely wiped out. They've been almost completely depleted. And so if consumers no longer have savings left in order to buy goods and services, how are they able to afford all of these goods and services in light of this record inflation? Well, as you can see on this chart, consumer credit card debt is rising. Consumers are now putting more and more goods and services on their credit cards, and consumer credit card debt is now the highest on record. So consumers got used to a certain lifestyle. They continued to spend as inflation rose and their costs continued to go up. They used the savings that they had built up during the pandemic in order to continue to buy these goods and services that they wanted. Once their savings got depleted, they started putting everything on credit cards. Well, as you know, if you have a credit card, that credit card has a limit to it. And sooner or later, consumers' credit cards are going to get maxed out. And when they do, consumers are going to be out of options. They're no longer going to have savings. They're no longer going to have available credit on their credit cards. And they're going to be forced to cut back on their spending. And once consumers are forced to cut back on their spending, that is when the real recession will kick in. The problem is the Fed is going to continue to raise interest rates until they see a real recession starting. And this rise in interest rates is going to very quickly accelerate the rate at which consumers run out of available credit, which means the recession is going to be accelerated into existence. So even though we're in a recession right now, it's a paper recession, nobody really feels it. But very soon, over the next few months, that paper recession is going to turn into a real recession. Keep in mind, the average recession lasted about 11 months. The average major recession lasts 18 to 24 months. Most economists that aren't just political are actually thinking this is going to be more along the lines of a major recession, kind of like the stagflation we had during the 1970s. So we're looking at probably 18 to 24 months on the overall recession. Now, I don't want you to get depressed. Obviously, if you're a consumer, this is very bad news, and it means that gas prices continue to go up, food prices continue to go up, the two things the Fed just cannot control, unfortunately, which is really going to put a damper on your pocketbook. So I want to encourage you right now with a couple of things you can do, because the fact is, recessions are when billionaires are made. John Templeton of Templeton Investments, Warren Buffett of Berkshire Hathaway, both of them became billionaires during recessions. And that's how millionaires and billionaires make their money. That's how they do it. They're patient. They wait for recessions like this. They load up when it looks like economically we might be near the bottom of that recession. And they make a ton of money over the next 4 or 5 years coming out of a recession. Warren Buffett did it. John Templeton did it. So many other people did it. And you can do it too. And I want to encourage you that it is possible. I don't care how impossible it seems, it is possible. Now, if you want help doing fundamental analysis and learning how to do all this value investing that's going to make so many millionaires and billionaires over the next few years, I encourage you to come join the VIP Discord. I told you yesterday I had 117 slots open. We had 91 people sign up for the VIP Discord over the last day, which leaves 26 slots available for the VIP Discord. Now, once those 26 slots are filled, I am going to close the VIP Discord. I don't want to allow too many people in there because we only have a certain number of staff members who are able to get in there and coach you and help you along. So I want to make sure everybody's taken care of, and I don't want our staff members getting overwhelmed. So I'm going to close the VIP Discord once we get those last 26 people to sign up. It's probably going to fill up sometime early Thursday morning, and then we're just going to close it out. And then once we're able to hire some more coaches, I'll open it back up again, but at a higher rate. So if you want to get in at the $20 a month, go ahead and sign up now. If you're interested in that, you can sign up at stockcurry.vip/getvip. That's stockcurry.vip/getvip. All right, I hope you enjoyed this video and got a lot out of it. Don't forget to hit the like button and subscribe. And if you're on YouTube, go ahead and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.